Warren Buffett is often called the greatest investor of all time. But did you know he started with just $120 at the age of 11? Today, he's worth over $100 billion. That's right, a small amount turned into an unbelievable fortune. Here's a mind-blowing fact. If you had invested $1,000 in Berkshire Hathaway 50 years ago, it would be worth around $25 million today. Yes, $25 million from just $1,000. It sounds impossible, but Buffett has done it, and his methods are available for anyone who's willing to learn. So, how does he do it? What secrets does he use to grow his money so consistently? In this video, we'll break down the steps Buffett takes to turn small investments into big returns, starting with understanding the basics of value investing. Stick with us, and you'll learn how to unlock these strategies and apply them to your own investments, whether you're starting with $1,000 or $100,000. Trust me, this could change your financial future forever. Ready to get started? Let's dive in. Chapter 1. The $1,000 Spark. Igniting your journey to million-dollar wealth. When you first start investing, it can be hard to imagine turning a small amount of money into something much bigger. But Warren Buffett's journey shows us it's possible. He began investing at just 11 years old, with a mere $120. Today, he's worth over $100 billion. The key takeaway? It's not about the amount you start with, but the mindset and strategy you develop along the way. Buffett has always believed that value investing isn't about getting lucky, it's about being smart with your choices. So, how do you turn $1,000 into $1 million? It starts with understanding that the first step is investing in companies, not stocks. A company is a business, and the goal is to find great businesses that are undervalued. You might be thinking, how do I even know what's undervalued? Well, Buffett focuses on companies with strong fundamentals, those that are financially stable and have consistent earnings. He also looks for companies with a competitive advantage, something that gives them the upper hand in the market. This could be a strong brand, like Coca-Cola, or a unique product, like Apple's iPhone. The beauty of Buffett's strategy is that he doesn't rely on speculation. Instead, he looks for companies with a history of generating value, then waits for the price to dip below their intrinsic value. This is called buying value stocks. The idea is simple: buy low, sell high, but it requires patience and knowledge. And here's the thing, it's easy to get distracted by the flashy stocks that promise quick returns. But Buffett teaches that slow and steady wins the race. If you can make informed decisions and stick with them, your $1,000 can slowly grow into something much larger. Chapter 2. Unlocking the Buffett Blueprint. The secret of finding undervalued gems. Buffett's investing strategy can be boiled down to one thing: finding undervalued companies. The trick is knowing how to spot these gems in a sea of potential investments. This is where the Buffett Blueprint comes in, and it starts with financial statements. When Buffett evaluates a company, he digs deep into its income statement, balance sheet, and cash flow statement. These documents help him understand the health of the business. Look at the profit margins, return on equity, ROE, and debt levels. A company that has consistent earnings and low debt is more likely to weather economic downturns. But there's more to it than just the numbers. Buffett also looks for businesses with a moat around them, something that protects them from competitors. This could be strong customer loyalty, patents, or unique technology. Think about how Buffett has invested in companies like Coca-Cola. The brand's loyal customers are its moat. Another critical part of the blueprint is the margin of safety. This concept means buying a stock when it's trading below its true value, which gives you a cushion in case the investment doesn't go as planned. Buffett likes to buy stocks when they are undervalued by at least 30% compared to their intrinsic value. This reduces risk and increases the potential for higher returns. The numbers don't lie. According to a study by the CFA Institute, companies with high ROE and low debt have outperformed the market over time. In fact, these companies have delivered annual returns of over 10%, which is well above the historical average of the market. Buffett also advises sticking to what you know. This is known as staying within your circle of competence. If you don't understand a business, it's best to stay away. Buffett didn't invest in tech stocks for years because he didn't understand them. But once he understood the value of companies like Apple, he dove in. Chapter 3. The Patience Playbook. Waiting for the perfect storm of opportunity. Warren Buffett's success didn't come overnight, and it won't for you either. One of the most important lessons he teaches is patience. It's easy to get impatient when you don't see immediate returns, but Buffett's strategy revolves around long-term thinking. In fact, he once said, "The stock market is a device for transferring money from the impatient to the patient." Buffett's investments are known for being held for decades, not days or months. He believes that, in the long run, great companies will always rise in value. So, when you're starting with $1,000, don't expect it to turn into $1 million quickly. Be patient, and let the magic of compounding work over time. One of the most famous examples of Buffett's patience is his investment in Geico. He first bought shares in the insurance company in 1976. He believed in its business model, even though it was a small company at the time. Today, Geico is a massive part of Berkshire Hathaway's portfolio, and its growth has been astronomical. Patience also means sticking to your strategy, even when the market gets bumpy. During the 2008 financial crisis, many investors panicked and sold their stocks. But Buffett saw it as an opportunity to buy. He famously bought large stakes in companies like Goldman Sachs and General Electric when their stock prices were low. In hindsight, this was a brilliant move. Both companies bounced back, and Buffett made billions. In fact, if you had invested $1,000 in Berkshire Hathaway stock 50 years ago, it would be worth over $25 million today. That's the power of patience and a steady approach to investing. Remember, Buffett's advice is not to try to time the market but to invest in companies that you believe will continue to grow in the long run. The key is to have a clear strategy and stick to it, even when the market gets volatile. If you can master the art of patience, your $1,000 can slowly grow into something much bigger. If you want more investing tips, don't forget to subscribe and hit the bell icon. We'll dive even deeper into the power of long-term investing and how to spot the next big opportunity. Chapter 4. Reinvest, Reinvest, Reinvest. How compounding creates million-dollar magic. Buffett has said that the most important thing to do if you find yourself in a hole is stop digging. In other words, stop spending your returns. Instead, reinvest them. The power of compounding, earning returns on both your original investment and the returns, has been a major factor in Buffett's wealth. When Buffett buys into a business, he doesn't just pocket the dividends or profits. He reinvests them back into more valuable opportunities. Over time, those reinvested earnings begin to snowball, creating exponential growth. Imagine this. If you start with $1,000 and earn just 10% a year, by the end of 20 years, that $1,000 will have grown to over $7,000. Reinvesting your returns every year accelerates the growth, and the longer you stay invested, the more powerful compounding becomes. Buffett once said, "Our favorite holding period is forever." He's a firm believer in letting investments grow and compound over time, creating wealth that far exceeds the original amount invested. This is how he turns small investments into billions of dollars. Chapter 5. The Circle of Competence. How to invest in what you know, and avoid what you don't. One of the most valuable pieces of advice Buffett gives is to stay within your circle of competence. This means only investing in businesses and industries you truly understand. Buffett avoided investing in technology stocks for years simply because he didn't fully understand how they worked. But once he understood companies like Apple, he jumped in. It's easy to get caught up in the hype around popular stocks, but Buffett warns against it. The key to successful investing is focusing on businesses you can grasp, whether that's a local grocery store, a well-known brand, or a simple service. The lesson here is simple. Don't invest in something just because it's trending. Instead, make sure you understand the company, its products, and its business model. If you're comfortable with it, then go ahead and invest. If not, it's better to wait for an opportunity that aligns with your knowledge. Chapter 6. The Buffett Mentality. Turning setbacks into stepping stones. Buffett's mental approach to investing is just as important as his strategy. He often talks about how to handle setbacks, whether they're market crashes, bad investments, or mistakes. His advice? Don't panic, and don't make decisions based on fear. As Buffett says, the stock market is a device for transferring money from the impatient to the patient. Buffett's famous investment in Goldman Sachs during the 2008 financial crisis is a prime example. While many investors sold their stocks in fear, Buffett saw an opportunity. He bought in at a low point and ended up making billions as the company recovered. The key takeaway is to stay calm and stick with your plan. The market goes up and down, but the best investors are the ones who can weather the storm and turn tough situations into opportunities. By following these strategies and adopting Buffett's mentality, you can begin to turn your $1,000 into a much larger fortune. Keep learning, keep investing wisely, and above all, stay patient. The journey to $1 million may take time, but with the right mindset, it's completely achievable. Don't forget to hit that subscribe button if you want more tips on how to grow your wealth using Buffett's methods. We'll guide you step by step toward becoming a smarter, more successful investor.